All right, time to go. And what's happening? Nice bounce, big bounce. Things seem to be coming back a bit. Hang on, I'm going to put away the questions so I can see the screen. Okay. And what were we looking for before? We were looking for 20-something. I wish I could remember. This morning we were talking about this, and we said that the S&P was going to test 2735. That's what we were looking for. Okay, let's see if we can remember these numbers. All right. Wait. I know what I can do. I can look at them on here. There you go. Now I want it to flip back and forth. All right. So, oh, I was stupid. I could have pretended I remembered. See, then you would have been impressed. So 2735 right here. That's the 50-day moving average on the S&P. And on the Dow, it's 25,525, which is, whoops, fail. 525 is right here. Oh, this is basically this line. So that was the Dow's 50-day moving average. Nasdaq 6680. Okay, so 6680. The Nasdaq is still safe at the moment. And the Russell failed for sure. It was 1550. That's the Russell's 50-day moving average. So basically, this is bad. And don't be fooled by the fact that we bounced back up. It's bad. We failed moving averages. If you're in a bullish market, you shouldn't be failing any, but you know, if the market is going to be bullish, then you're not going to fail the moving averages. Not on a regular basis, okay? It should be firm support. That's the bullish market. Especially the 50-day moving average, the 200-day moving average. If you're going to be moving up, those things should be firm support, not kind of sort of support. And that's what we're seeing now. We're seeing barely any support on these moving averages. We're going right over them, but then we go right back under them. That's more of what you expect when the market is being manipulated over the averages and it can't sustain it naturally. And that seems more like what's going on. All right, and already people see it catching on to them and they're starting to sell. That's right, the jig is up, boys. So I don't consider this bullish for the market. I don't think this is a good position. We'll see what happens, but it's really about it's where you settle. It's not where you start. But the bottom line is now, as far as being bullish, you have to see a sustained move that proves the moving average. Okay, like how can I explain this? I mean, look, let's say, all right, let's say you are making a barrier, you know, like a dam or something like that, right? You want to make a dam, and you want to prove the water is going to stay in the dam. Okay, so that's the same thing. So pretend the 50-day moving average is a dam. Now, it doesn't. If the water stays in the dam, it stays in the dam. It doesn't sometimes go spilling over the dam. Then you haven't got a good dam, right? That's what this is. The water is spilling over the dam, and therefore you don't have a good dam, which is the same thing as saying you do not have good supports here. Okay, if they were good supports, then it would never go under. That's what a solid support is. A solid support isn't sometimes it goes under. All right, like like look back on the. All right, well, let's take a look at the bigger chart. Let's see what we got. I'll show you what a good dam looks like. All right, indexes, S&P. Don't forget the S&P is the only real index. The other ones are all, you know, the NYSE, the S&P are the real indexes, and the Russell actually has 2,000 stocks too. You can't, you know, a stock with 100 stocks in it is not an index. And you got, I mean, you know, the Nasdaq 100, that's not an index. The Nasdaq Composite, I guess you can follow, but also it's just too heavily weighted by a few stocks. That's the problem with the Nasdaq. And the S&P also, compared to the NYSE, nothing counts. But they don't have a chart of the NYSE, so I use the S&P. Anyway, so 2,200 on the S&P is our must-hold line, and 2200 on the S&P, which is really right about here. As you can see, it's a very firm barrier on the way up, and then once it broke, it never comes back. Never, ever, ever comes back. Before that, we were down at like I think 1500 was a support at some point. And if you look at 1500, right, it held a support, a little bit damage, and a little bit damage tells you it can be broken. Goes back under, comes up, a little bit damage. It can be broken, but it isn't broken. But if you're a dam builder, knowing that it can be broken, you better fix your dam. So meanwhile, and then the third time is the charm, went over it, never comes back. That's where you get bullish. It never comes back. When you're up here, you say, this is never coming back. Or if you test it, you better damn well test it, and it hits hard and doesn't go below. A little tiny spiky thing like that, maybe, but not a real move below. You know, when you're breaking up to a higher level, it looks like you're breaking up to a higher level. Okay, when you're spiking them down. Now these are monthlies. We'll try weekly, see if that makes any sense. See the weekly? So let's, you know, if you want to call 26,000 or 25,000 a higher level, you don't go up and then back down and then up and then back down. That's not how it works. Okay, when you're going up and back down like this, look, up and back down and up and back down, and then like this, all messy. What happened? Down. That's what you're kind of doing here. You're coming up to a higher high, coming back down, then you're struggling to get back up, then maybe we fade back out again. These are weeks, don't forget. And then up and try again, and try more, and try more, and try more, and try more. There's a whole year of trying, or 6 months of trying in this case. This is 6 months of trying, or really all the way from here to here is 8 months. And then finally failing and doing a proper consolidation, which is actually, this is a very significant line on the Dow. The Dow is 8,000, 16,000, and 24,000 are the very significant lines on the Dow. So far, 24,000 is showing as good support, but that's a long way down from here. We're at 25.4. That's another 5% below where we are now. That's certainly showing good support. This one little spike on a weekly chart, how long did it actually last? Let's see. We were below 24,000 a couple of times, but barely, you know, not even really for more than a day were we below 24,000. That's good support. That shows that 24,000 is that's showing you 24,000 is unnatural below 24,000. Doesn't stop you from going down 1,000 points to 23,000, but it does show you, though, since it's so robust in a comeback, that the 24,000 line has very strong support. There's a lot of people here who are willing to buy at 24,000. That is not the case at 26,000 because obviously it's not firm support. That's what support is. Support means there's a line, excuse me, there's a line at which people are going to buy, that they put their foot down and say, bullshit, I will buy at that price. Like me with GE at 15, okay, even though it's 14 now, or whatever the hell it is now. At 15, I started buying it, and when it went lower, I bought more and more and more because 15 is where I draw my line on GE. Just like I'm going to draw a line on GE, there are major funds that are drawing the line on the Dow, on the S&P. Warren Buffett says, at this price, I will buy my stock. He will not buy his stock at any other time, but if it goes below, I don't know what it is now, like 140 on Berkshire B. It's probably higher now, probably 160. I'm sorry. You know what? I have an obsessive compulsive thing about that kind of stuff. I can't, if I say something, I can't like let it go. I have to know what the actual number is. All right. Wow. Wow. Really? I find it hard to believe that Buffett would buy at 180, but I don't know what his new number is. I didn't check, but I thought it was. I know it was 140 at one time back here. So like a year or so ago, it was 140. I assumed it was 160 now. It could be 180. I don't know. It seems like a stretch to me. I don't think I would be buying at 180. Anyway, but Warren Buffett always has a line that he says, this is what my company is worth. And if it goes below that, I will buy the stock. It's a fact. And that's the thing. See, yeah, I was talking about this at the at the PC Expo, whatever the hell Expo was, the Traders Expo. I was saying to the people at the Traders Expo, you guys are, probably not you guys, because you're here. But the average investors are mostly technical traders. And technical traders think everything is about the chart. But the reality is the money is not a technical trader. The money is trading fundamentals. And the money knows what price they're going to come in at. Okay, so even the chart guys have a spot. But the point is the money guys, they're going to come in at a certain price. The value investors who have huge amounts of money, whose money swamps all the technical traders. Retailers are technical traders. Okay, rich people are value investors. And there's a reason for that too. There's no technical traders who are like the richest people on earth, but there are value investors who are the richest people on earth. So the value investors who come in with the real large amounts of money, they've got a spot that they're going to come in at come hell or high water. And they cause these resistance lines. And what we do in the big chart when we're determining our lines is we say, okay, the fundamental principle is how much is the S&P worth today? How much money? And I looked at, when we did our S&P numbers, we looked at 100 S&P companies, and we looked at how much they were each worth, and then we calculated the value of the S&P 500. And that's where we came up with 2,200. And it's way down now, but I'm telling you, the 2,200, where is that line? Right here. 22, and we did it over a year ago. That's the point. 2,200 is where we said the S&P is a must hold. In other words, it has to hold this, otherwise we're in a super bearish market. It did hold it. It went over the 2,200 line. And then from there, we expect it to go up 20%. Sure, it's easy to go up 20%. And 20% is what? 20% is, it's not even here. 2,600, 2,640, whatever. Yeah, 2,640, that's right. So 2,640 is a 20% line. That's expected. The chart, we changed the chart when it significantly holds that 10% line for an extended period of time. That's when we'll change the chart and move it up to the next level. But for now, these lines are still in play. Until you see no red on there for a while, these lines are still in play. And we've never had a time so far when there's been no red, because the NYSE is constantly dragging. It's barely over its must-hold line at 12,800, right there on the S&P. No, that's 6. Sorry, that's 8. 12,800 right here. So that's where the S&P, I get my things wrong. That's where the NYSE is. So the broad market indicator, that's the most reliable indicator, is telling you that this is where the bulk of stocks are. They're right at their must-hold line. They're at their proper value. These guys are overvalued. By how much? By 5%, by 30%, by 22%, whatever the hell that is, by 25%. That's how much they're overvalued. Now, I would concede that based on Trump's tax plan, which is long since these numbers came out, Trump's tax plan, the repatriation of funds, which causes more buybacks, which shrinks the amount of shares and increases the apparent profits of the companies. Same profit, is just more per share because there's less shares. Those factors, I would say I easily could give it another 10%. So I'm very willing to move the must-hold line up 10%, but you know what? The NYSE companies don't agree. You know why they don't agree? They don't benefit from any of that crap. Okay? A few hundred companies benefit from those things. The other companies do not benefit from from these changes. They didn't have any money overseas. They haven't been avoiding their taxes. They aren't repatriating anything. And the lower taxes they're getting going forward doesn't help if you're not that profitable. It's not a big deal. And then that doesn't get made up by the rising wage pressures and so on and so forth. Plus the fact that the privileged companies that are getting all the breaks are able to outcompete these poor guys, and they're crushing all the smaller companies. They're getting hurt. Company like Amazon, which has infinite access to free money, is able to put everybody else out of business, even though they don't make any money. This has never happened in history. A huge corporation like this can sell. Now, it's happened for a short amount of time, but for a large amount of time, a gigantic corporation can sell product at a loss, not a product, not their product, a wide range of other people's products at a loss, competing against all of retail. And the cheap financing also helps companies like Sears stay in business forever, even though they should have gone out of business. You know, things can go on sale and companies can sell stuff at a loss, but eventually they're supposed to go out of business and stop. It's not healthy. It hurts all the other businesses that were healthy. And it forces them to go out of business until, guess what? There's only 2 or 3 companies left, and then they can charge whatever the frick they want. That's how monopolies come about. We had, you know, it's funny, they always talk about the Constitution and interpreting and this and that. It's like, we had a time in this country where we were busting corporations. They were called trusts. Monopolies were called trusts at the time. And Teddy Roosevelt, 1900s, or whenever the hell he was president, around the 1900s, he's leading the charge of what they call trust busters and breaking up the monopolies. And the courts were finding them illegal, and they were interpreting the Constitution and say, you can't do this. This is wrong. We have laws against this kind of thing. They would never have allowed Intel, Microsoft, Facebook, Google, all these gigantic companies that control so much of the economy. They would never have allowed them to go like this. They would never allow Amazon to sell it. The whole concept of selling at a loss and driving your competitors out of business is ridiculous. But that's business now. That's the definition of capitalism somehow. Uber is running at a tremendous loss. It's like, Uber runs at a huge loss because that way nobody else, there's Lyft and whatever, but it makes it very hard for other people to compete with them. It's not complicated to do what Uber does. Anybody who makes an app can do what Uber does. But because Uber crowds out the market, it makes it impossible. It makes it hard for a smart kid who has a better idea to come along with a better ride service, because Uber's already got $60 billion and they can crush everybody. So it also stifles innovation, and it hurts productivity in the country when you don't allow capitalism, which is, I thought what the point was, is allow capitalism to flourish. Monopolies do not allow capitalism to flourish. Monopolies fix the status quo. That's what they do. No changes. We're in charge. We tell you what you're going to get. It's crazy. And we talk about, the only thing that we talk about now are disruptors. And disruptors are basically people who do upset the status quo. But look how hard it is for these disruptors to come along and take a place. But once they take a place, they become the monopoly. All you're doing is killing the king and replacing the king with a new king. So things are messed up. That's my summary there. Things are messed up, and we have to think about that when we're trading and buying things. Now, meanwhile, look at this. This is not nice. The Nasdaq, this is why we shorted 7,000. The Nasdaq had obviously hit 7,000 and decided that was not for me, and then dropped, what is this, dropped 15%. That spike down is 15% at the bottom. Then it came back 15%, just as fast pretty much. But not quite just as fast, because that hesitation here at the 25% line gave me the confidence to short at the 30% line. I figured it has to be rejected at least a little bit. So it was. But now, what are we looking for? We're looking for, if the Nasdaq is really going to break up, we're looking for smaller retraces. So we had a nice move, little consolidation, double the move, big consolidation, half of that move, no consolidation though, then pops right over. So basically we doubled the move and then pretty much continued the move. Now, if we consolidate here and we hold 6,900, that's a good sign that it could be consolidating for a proper breakout over 7,000. So the most bullish thing you would see in the coming weeks is going to be if you see the Nasdaq hold 6,900 and move up to 7,000. The Nasdaq, don't forget, because what happens is that if it does that, the 50-day moving average catches up to 6,900, and that becomes the firm support, the rising 50-day moving average, and that lets it rocket higher. So if you're going to use technical, you have to think about how the technicals are drawn and what causes them to be drawn. So staying up here drags this average higher. Going below the average drags the average lower. So in other words, if you see the NYSE stay below this line and consolidate here, then this line is going to start curving back down, and that's going to be more downward pressure here, and it's more likely to break lower. And then if it breaks lower, it's going to make more pull on that line, and that line's going to go lower still. And then you're screwed, right? Because then you're in big trouble. So it's good to think about, even if you're using charts that have the shorter term, even if you're day trading, I mean, that's just the reality of how these things work. So if you're day trading, you set up 1 hour and 4 hour lines and things like that. It's a good way to watch them, because you need that stop looking backwards and start looking forwards if you're going to play TA. Start envisioning what the current movement is going to do to influence those lines, because instead of looking backward and saying here's what the setup is, think about what the setup's going to be in whatever it is. If these are 5-minute candles, so you say in 10 more candles, what's going to happen to these lines? That's the way to do TA. So because you want to know what's going to happen in the future, not what happened in the past. And that's why all these alert systems for TA, I think, are bullshit, because they tell you something made a bullish cross, something did this and that. It's a good signal, but the reality is it's too late. You missed your chance. But you could have seen that signal. I can tell you, look, he's going to make a bearish cross. I can see it. This is a 20-day moving average. Is going to bearishly cross the 50-day moving average. There's basically no way to stop it. Unless the Nasdaq really rockets way up, the 20-day is going to fail the 50-day. That's a bearish cross. It's going to happen in 2 candles, maybe 3. If the Nasdaq stays up here, might be 3, can't be 4. It can only be 3. So they've got 2 days, maybe 3 days before the 20-day moving average falls below the 50-day moving average sharply, which is a bearish technical indicator. And God forbid that the Nasdaq confirms that by failing the 50-day moving average at the same time, and this thing's going to look ugly fast. And where are we now? We're not at 6,900 now. We're at we are at 69. We're at 69.45. So what day is this? Oh, this is yesterday's chart. Okay. So we're at 69.45, which is right in the middle here. So this is more likely than 2 more days at least. So maybe they will squeeze 3 days out of it. So that's tomorrow's Thursday, Friday, and then Monday, and that means Tuesday is a very dangerous day for the Nasdaq. So if the Nasdaq is not over 7,000 by Tuesday, it is more likely to start falling back below 6,900. All right, that's how you read a technical chart. So we'll talk. So next Wednesday, somebody mark those words, and we will see what happens. All right, but this is my prediction, because here's what's going to happen next week when we get together. This line is going to be below the blue. Nobody else has that problem. The Nasdaq has that problem because it's the most overbought index, and the 20-day moving average is going to fall below the 50-day moving average. Now, if that was a 50 crossing the 200, that'd be called a death cross. And still a death cross. It's just a short-term death cross. It's going to exert a lot of downward pressure on the Nasdaq, and what we might see is this M complete itself. See how we got kind of like half an M? You might see the rest of the M come back all the way to 6,500. That'll be the next support. It's right about here at the 20% line. That would be very, very ugly. People would freak out if the Nasdaq drops 5%. So that's what we're going to watch out for. Now, that's not likely to happen if Apple doesn't have something bad happen to it. So that then, if I was going to use that as like a real big premise, that would then lead me to look at Apple and think about what's going to happen to Apple over the next week. All right, so step 2 is then I go to, because nothing matters in the Nasdaq if Apple doesn't go down. So then you look at Apple and we say, how's Apple looking? Well, they're looking pretty strong. They're over there, they're well over their 200-day moving average. This chart shows it better. They've been up and down, but this is not a strong 50-day moving average. It's a little stronger now. It was in trouble. Then it popped back, but they're having a lot of trouble at 180. So they're kind of in the same place. I don't have the shorter term moving average on the Apple. Oh, maybe on this. Excuse me. Maybe on this FinViz chart. Wait, that's not it. Let's try that. Bum, ba, bum, 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 bum. Yay. Aha. Open a new tab. This probably has a shorter term thing. Oh, really? Okay. The purpley thing, I don't know how well you can see it. The purple line here, that's your 20-day moving average. It is not going to fail. The way Apple popped up, it is not going to fail. See how it drastically turned back up? It's not going to fail the 50-day moving average, which is, wait, 50 is orange. Here's orange. So this is a reprieve. It started falling. It was going to cross. Now it has a reprieve off this huge pop. But it's very possible that the huge pop is bullshit. Now we got to go back to the news and say, why did Apple pop? Did it pop for good reasons? Is it likely to get to the top here? It could, because there's no resistance until it gets up to about 185. So was this fake? And if this was fake, we'll fail 180. If this was real, we'll hit 185. And if we hit 185 and then hold 180, then Apple's consolidating for a move higher. And then the whole Nasdaq is consolidating for a move higher. So that's the trigger signal that we can watch for. All right, now let's see if we have any questions. Do you need the release? Oh, oops, I forgot. Oh, well. All right. Access to this webinar is for informational, educational purposes only, and we're not responsible for anything. And if you're watching this, pay no attention, and you waive all rights to anything you ever did in your life. All right, thank you. Pretty much what it says. Yeah, sorry about that. I forgot. What do we do? Maybe Greg can edit it in on the other thing. What do we do with ABX as miners take a big hit, please? What calls can we sell on GE? And well, look at all these questions. Really? May, that's a lot of questions. All right. May wants to know, what do we do with ABX? Okay, so here's the thing. That's a good question, although it has nothing to do with what we're talking about now, but that was just my overview of where we are as far as watching the market for the moment. All right, so ABX, what portfolio is this? This is the OOP. So in the OOP, we have ABX. We have the 10-20 bull call spread on ABX. ABX is now at like 12. We sold the $15 puts, but it's out in 2020. So, I mean, yeah, it's down, about $3,000, but that's not important. I don't want to be flippant about that. I mean, it's obviously $3,000 is $3,000, but it's 2 years from now, this trade. We spent 94 minus 3,550. So let's say basically about $4,000 on this trade. And it's down 3,000. It's down 75% of what we spend in cash. If it goes well, we get $20,000. So really, we took a chance with $4,000 to make $20,000. As it stands now, we're down $3,000, but we're not really off track because, first of all, we have 20 $10 calls. The stock's at 12. If the stock stays at 12, we get $4,000 for these calls. We would then get assigned, but the point is we would get $4,000. That's all of our money back, and the only thing we'd have to worry about is being assigned 1,000 shares of ABX at $15 when the stock is still at 12, if it's at 12, obviously. And then we'd be down $3,000, which is what we're down now. So if it holds 12, there's not really an issue, okay? We're not going to be down more than we're down now. It looks ugly on the thing because, oh, shoot, did not mean to do that. You know, when you're using leverage, it's going to look ugly when it goes against you, but that doesn't mean it's failing. And you can't just always do something. Okay, they're bottoming out. Let them bottom out. Oh, hang on one second. Sorry. Okay, where were we? So there's no fixing ABX. So I'm not really in the mood to put more money into them in case that specific miner has a problem. I would rather at this point, since all the miners are down, I don't think it's just ABX. Hang on a second, let me make that smaller. So GG is another good miner. And look at them, they're in the dumps also. Okay, and even CDE, who we have also in one of our portfolios, they're down. They're not as badly damaged, but they're down too. So all the miners are off. Harmony is another one, HMY. Ooh, Harmony's doing well. That's funny. That's another. My three favorite miners are Harmony and ABX, Harmony, and of course NAK, because it's purely speculative, but I like NAK. And NAK is way down too, but they're down for other reasons. They're down because they're in a total disaster with the EPA. But that's why it's speculative, because if they ever resolve their disaster with the EPA, and honestly, under Trump, it's like, what EPA? But if they ever get out from this thing and are allowed to start doing it, you know, they have a huge mine. They just aren't allowed to mine it because of the environmental concerns. If they ever get past that, this thing's going to shoot right back to $3. So that's why I like them. It's a fun speculative stock, but just as likely to go to zero. Anywho, so ABX, getting back to that. Look, it's a good, solid, long-term hold. So, and we have a very tiny amount of it, frankly. I mean, we only have 10 puts. So we haven't made a huge commitment. So basically, also, okay, here's an also. Also on ABX. So we sold, come on, brain. Where was I? We sold the $15 puts and we sold 10 of them in 2020. So all right, so 2020 we sold the $15 puts. It doesn't matter what we sold them for. Since we paid net $3,000 for the spread, then basically we sold them for $3, right? Because if the bull call spread expires worthless, then all we have is the $3,000. I'm sorry, we paid $3,000, so we would actually be more like net 18. But anyway, the bottom line is we have these puts at $4. If they were the January 15 puts, they'd be $365, and here they're $415. But let's say in January, let's say it becomes January, like 12 months from now, and we're at 375 or 365. No, we wouldn't be though. If we'd be at 3 because it's 1168, so under 12. We'd be about 330. Now, if we were at this exact spot in January when there's no more premium, these would be 330. Then we'd look ahead to a year and say, well, what can we roll it to? Then we would pay $1.30 to roll to the 13 puts in the following year. Right now, the 13 puts at 267. So even now, it costs about the same $1.30 to make that roll. That's all it is. So then if we decide that we're not going to dump it, we keep going. At the moment, we still think it's going to come back. If we decide it's not going to come back, we take a hit. But if you think about it, in a $100,000 portfolio, we're talking about taking a $3,000 hit if we shut this position down. That's not life and death. You can't adjust every position every time it goes against you. Some positions will go against you. The thing is, you're going to stick with it. Do you still have faith to stick with it, or don't you? So what was the question on the other ones? You were talking about ABX. What call can we sell on GE to collect premium on 2020 long debit spreads? We were not up to that yet. It's only just beginning to recover. Ooh, it fell back to 14. Damn. Well, they were just beginning to recover. What do we do with FTR and what cover call? Again, FTR is another one. Just leave it alone. Also, what's your outlook on Best Buy? I like Best Buy. Look, we're going to go through portfolio adjustments in 2 weeks. When we come towards the rollover time is when we do our portfolio adjustments. It's not even March yet. So if we're going to make any moves, unless something drastic happens, and nothing drastic is happening, GE's consolidating down around 14. ABX is down around 12. We don't know if they're going to go lower or not. We're going to wait and see. GE FTR is doing exactly what we thought it would do. I put out a note yesterday on FTR. Look, I don't know what else I can say. I mean, I put out a note yesterday on FTR. Where is it? Here we go. FTR. Here you go. To avoid a lot of damage on earnings, you could cash the stock at $9.19, buy 15 of the $5 calls, so that's net back in your pocket, and that would leave you with instead of having the stock, you would have had the 5 and 8 spread. And if that were the case, what would happen? The 8s obviously came down in price. You would have bought the 5s for $4.20. How much are the 5s now? Now the 5s are $2.90, so you would have been down $1.20 on the 5s, but the 8s lost a lot of money. The 8s are down to they're not even $2.35. It's $1.60, $2.35. So these are down to like $2, and they were $3.50. So these guys lost more. It was exactly what I thought would happen. These guys lost more than these guys did. So if you flipped out to the spread, first of all, you would have cashed the $9.37. You'd be thrilled. Now you'd have the spread. Then you could buy the stock back at $7 or whatever the heck it's at now, and so you would have saved $2 off that, and then you could cash that and take the dollar loss. So you would have net saved $1, and you're back on the same spread. But if you didn't do that, to say now how do I fix it? No, you can't fix it now. Stick with the spread. Yesterday I said if you want to avoid the damage on earnings, do this first, but not after the fact. I can't magically make these things happen. It's too late. So you got to wait now. We knew this was going to happen, though. We expected this to happen. It's not a surprise. Now we're just going to see what happens to the stock. We still like the stock long term, and these are 2-year trades. It's freaking March, 2 years ahead of the thing. It's not you can't worry about all your positions like that. It's crazy. How can you sleep at night? You have to let things play out. So what do we do with FTR? Also, what's the outlook on Best Buy? That's the last part of the question, although I see you have another question right after that. So Best Buy, or Bed Bath Beyond. Wait a minute, how many Y's were in that? How many Y's were in how many B's? I mean, Bed Bath & Beyond, not Best Buy. So Bed Bath & Beyond is, I don't have a target for everything. I just know that this is a good price to pay for them. And we have Bed Bath & Beyond. It's in our portfolios, maybe not in this one. Yeah, it's right there. That's our target, $25. It's at $22 now, $21.50 now. This spread is flat. So this exact spread, the 5 short 1750 puts. 1750 seems like a really reasonable price. 5 short 1750 puts, 10 of the 1750 25 spreads. So that's a $7,500 spread at 25, and the net price you're paying is $645 minus 350 is 3, minus 280 is like 20 cents. So basically, for 20 cents, you will get back $7.50 if this trade goes well. Don't forget, though, if this trade goes down 50 cents on you, you'll be down 250% of what you started with, which was 20 cents. You'll be down 50 cents on 20. So, again, it's a trade that will look horrifying if it goes against you. But meanwhile, you're down 20 cents. What's the big deal? That's what the leverage does. If you win, you get $7.50 back on 20 cents, which is, I don't know, a large amount of money, like a 1,500% gain or something like that. So, I mean, that's the thing. When you're playing for a 1,500% gain and you go down 100%, that's not a big deal, because you were going to gain 1,500%. So you're only down, you're not even down 10% of what you were hoping to gain. That's realistic. You have to understand that if you go into these trades that make 1,000%, they can go against you 100% really easily. You have to get used to that. You're going to have losses in your portfolio, but the trick is, there again, the trick is to keep your allocation blocks reasonable so that you're not overextending yourself, because that's the problem. You don't, just because you can make, look at what we did here. We only have 5 short puts. It's a very tiny position. You say, well, geez, the whole position only cost, what do we say, $64.50 minus 3,500 is oh, I'm sorry, that would have been, it would have been 20 cents if you did it that way. We didn't do it that way. It's because it wasn't a full sell here. It's $64.50 minus 3,500 is 3,000 minus 4, so $1,500 bucks. So you're in for $1.50, sorry, and you get $7.50 back. So you only get 500% if you do it, because we did it much more conservatively by selling 5 puts. But so in this spread, you're only putting out $1,500 to make $7,500. So yeah, of course you say to yourself, well, if I put out $15,000, then I get $75,000. But no, because the problem is that could easily go against you $30,000. And that would be an inappropriate amount to put in this portfolio. Just because you can win a lot doesn't mean you should play it. You always have to be aware of the downside. This trade can go, so this is a $1,500 trade that makes $7,500 bucks. It's appropriate for this portfolio. $7,500, by the way, is 7.5% of the entire portfolio. You don't need too many trades like that to have a great year. You don't go and double it and triple it and quadruple it, because then you're putting your whole portfolio at risk over one trade. That's crazy. These are meant to be small, controlled amounts. And if you lose a little bit of money, like Frontier, 1,500 shares of a $7 stock is $10,000. If we get completely wiped out of this position, we lose 10% of our portfolio. That's as big as any position should be in a small portfolio like this. Notice there's no Apple here. We have these Apple shorts, the short puts, because I think that's like money in the bank, basically. But we wouldn't buy those. We would have to stop out of those because we can't afford to buy this much Apple. But since we think it's super safe, we think it's going to make us $5,000, so we're going to leave it in there and see what happens. Not if Apple drops to 120, but I'm saying, I mean, as long as it's holding 150, we don't mind. But we don't have Apple stock because we can't afford that kind of swing. I don't think we have any stocks that are really $100 and something in here, do we? No, we don't. Nothing in here is a $100 stock because it's not appropriate for this portfolio. Here's the most expensive one we have is Alaskan Air. What happened with Alaskan Air? We sold the puts, 5 of them, risking a $30,000 assignment. We sold the puts, like these puts we sold. We got a good price on those. The stock came down, and then we took the spread. But that's because it became an exceptional bargain, and we wanted to stick with it. But that's the only big stock we have, and it's only a $60 stock that we actually, it's only $60 worth that we actually have in the stock. Yeah, Yeah, everything else is more, I mean, it's appropriate to the portfolio. It's 20, 10, 20 shares of a $20 stock. At, a $20, $25 stock, $10 stock. You've got to keep your risk appropriate to the portfolio. You can't have any position where you're freaking out if it's going to go up or down. This is the OOP. Can you please post a more updated OOP? Yeah, we updated the OOP 2 weeks ago when we made the changes, and we update the OOP 2 weeks from now when we make the changes again. Once a month, we update the OOP. When we make the changes, we update it. We don't update it daily to obsess over. In fact, we're trying to teach you not to obsess over your positions. As part of the process is learning not to freak out about every position every day. When you roll the long calls down, as in the case of ABX, is that cost reflected in your power options portfolio? Yeah, of course it is. It looks like it just shows it. Yeah, well, no, wait. Yes, it just shows the current position because the old position is closed. That's why. A roll means you close the leg and you open a new leg. And all you said when you say roll, you're doing the net cost of what you did. So if I'm rolling, hey, if I roll the $70 calls, which are $9, to the $60 calls, which are $13.65, I'm going to roll the call for $4.60. Okay, but mechanically, all that is shorthand. All it is shorthand for saying that I'm closing the 70 calls. I take a loss of $525 on my 70 calls. I then open the $60 calls at $13.65. So these are gone. The loss is recorded into the balance of the portfolio, and then $13.65 is the only thing you're going to see open for one call because the other one is closed. That's what a roll is. It doesn't show every position that was ever in the portfolio. That'd be crazy because the cash, it drops down to the cash balance. When we took a hit today, look at that, we're down 5.3%. Let me see something. How's the market looking? Is it bad? Nope. Oh, I'm just chugging along. Yeah, that's weird. But you can't, the problem is you can't go by intraday amounts in the portfolio. That's another thing, by the way, is that sometimes these intraday numbers freak you out because this morning, this thing was up 2%, and now it's down 5%. And part of it is FTR, but part of it is just that the numbers fluctuate on a regular basis. Now it's down 5.9%. I mean, because you've got the bid-ask spreads, and those vary, and it's not gonna firm up the numbers until the end of the day. So this kind of portfolio is going to fluctuate a lot up and down. But the question is, as you go over each position, is it on track? So is ABX off track? Well, let's see. We have the bullish 10-20 bull call spread 2 years from now, and it's the stocks at basically 12. We sold the $15 puts. We sold them for $2.35, so we net in for $12.65, and it's at $11.70. Do I think ABX can't get back to $12.65 by 2020? No, I don't have that problem. I don't believe that's the case. I don't think it's not going to get back to that. Therefore, should I worry about this position? Don't kid. I didn't say how much is the balance. Notice I did not say anything about how much money I won or lost because I don't care. It's not important. What matters is my position valid? And if it's valid, I'm going to stick with it. If it's not valid, I won't stick with it. The fact that I lost a bunch of money indicates I can probably make an adjustment that makes it cheaper. But as I just said, I'm not really in the mood to increase my exposure to one stock. If I was going to make an adjustment, I would pick up GG or more CDE. We already have CDE, so I'd be more likely to add to our CDE position, but that's already a decent sized position. So probably so the end result here is we already have enough exposure to gold. So maybe gold's going to remain a disaster. Maybe the dollar's going to get super strong and gold's going to go back to 1100 and these things are going to completely crash. And then I'm going to double down. But now I'll just leave it alone and see what happens. Concern the dollar may be getting stronger. That's right. I was telling you guys the dollar was going to get stronger for how long? I said it was too cheap. So 92 is where the dollar should be. So we could be in for more pain on the gold. But that doesn't mean I'm going to change it day to day. Should I sell the ABX 14 calls for 2020 to recoup the losses as I just roll those to 2020 $10 calls? What? All right, man. If you have like super specific questions like that, let's go over them in chat, because I can't like go over everybody's individual positions doing the webinars. Phil, have ENB stock also sold the 3250 calls to 35? Would be grateful for your view and how to roll it forward. You have ENB stock. Where is that? So I can't do this. I can't stop for every single person who has a special. This is what chat room is for. Okay, it's not what the webinar is for. We can't like do everybody's specific little positions, because then we'll never get anywhere. ENB in stock and sold July puts. So I have no idea what ENB is doing. It's not one of our stocks. So ENB. Okay, so you have the stock, you sold puts, and you sold calls. And the stock's at 32. I don't understand the question. You sold the 35 calls, the stock's at 32.50 now. So what's the problem? You sold the 32.50 puts, the stock's at 32.50. It's on target. What happened? Did it pull back? I don't know, because we don't follow this stock. It's not a stock we play. I'm not even sure what it is. I haven't watched these guys in ages. Oh, I see. Wow, did they take a tumble, huh? Well, I can't answer it because I don't know why they took a tumble. I don't know what's going on with the stock. But I'm telling you, at the moment, you're on track. So what do you want to do? If you don't like them anymore, close it. You can't be down that much. I mean, just close it and get out if you don't trust the stock anymore. But I mean, that you should have made that decision when they failed. See, here it is again. They failed. Oh, see this? Death cross. This is when you should have decided that you should probably be thinking about doing something about your stock, is when the 50-day fails the 200-day moving average. This is exactly what I'm talking about. This happened. It pulled the 50 below the 200. You come up and you consolidate between the 50 and the 200. You popped over, popped back, tested, popped back. Right here is when you know things are going very badly. When you fail that 200 again, it's no longer support. You test the 50, that's not support. You know you're going down when that happens. So the question is why? I don't know. I didn't read their earnings report. I'm not sure what's going on with these guys. But if you have no faith in them, then you can't ride it out. But holy cow, I mean, if you okay, this is again. I did a 4-hour seminar at the show, so I'm sorry if I feel like I'm repeating myself. I'm a little exasperating. I'm like saying the same things I just said to everybody, but you weren't there. Anyway, here's the problem that a lot of you guys have. Okay, you're in at 32.50, 35, right? You don't sell at 40. So you refuse to take a profit when the stock is 10% higher than you thought it was going to be. But when it's 10% lower, when it's 5% lower than you thought it was going to be, you start worrying and start thinking about changing your thing and in effect, taking a loss. That's no way to play the market. You're basically guaranteeing that you're always going to be spending money trying to catch up, and you're only going to take, you're hardly ever going to take an actual profit. If this is the point you panic, then that's the point you should have taken a profit. You have to know when you're going to hit your points. You have to have a range that you're comfortable in and a range you're going to get out and do something about. And the answer is not knee-jerk, sell the call, do this, do that. That's not how these things work. You have to analyze the stock, and I don't have time now. And again, ask me in chat. I'll be happy to look at it. But you can't just, based on the number, make a decision like that. It depends on what they're actually going to be doing. Now, IMAX, Naomi's asking about IMAX. We do IMAX. We follow them closely. The IMAX sell-off today is idiotic. I don't know what the hell is going on. Are they still down? I couldn't believe they sold off on those earnings. I think it's because in the conference call, I hadn't had a chance to check, but in the conference call, they must have once again warned about China. Let's see if Zach says anything about this. Total revenue, strong top line. I mean, this is insane, right? Revenues were in line. Bottom line improved 54% from last year on higher revenues. Revenues were better than expected, up 17.4%. The top line was surpassed. And don't forget, they were telling you what a bad box office year was going to be, but IMAX had huge revenues. And last year was not a particularly great box office. This year is going to be a fantastic box office. Okay, the Marvel's Inhumans Impact under the review. That was that movie was a disaster. That was one bad movie for them. I don't know what they mean by under review though. While global box office revenues included increased 13% globally, category-wise equipment, blah blah blah, services. So they sell a bunch of stuff. Big deal. All right. Theater business was up within the segment. IMAX system sales and leases, and don't forget they sell cameras. They sell cameras to people making these IMAX films too. The network business had revenues that were up nicely. Other segments' gross revenues were down. With film distribution plunged a massive blah blah blah. That's a random thing. It's such a small number. It plunged to See, this is the thing. They say plunged 58% to $1.8 million. It's a nothing segment. It's not a big part of their business. So they had a big bump last year for whatever they did this year. Liquidity, obviously, they got plenty of money. Net worth growth. They installed 170 theaters. Compared to, they installed about the same amount of theaters. That's how big they are. They can only install that many. They signed 177 more, so they replaced for every theater they built, they signed another person who wants to build a theater, and their backlog is 500 theaters. 3 years worth of building is a backlog. And there's nothing here that says anything particularly negative other than the Inhumans thing. So on the whole, there's nothing bad about this. It's a silly reaction. It really is. In our IMAX play, I believe we're looking for like $20, right? So yeah, we have a 15-20 spread on IMAX. Do I think it's going to hold 20? Yeah. I absolutely. And if it doesn't hold 20, I would buy more of it. Axe and thoughts on the CEO package? Yeah, screw him. That's ridiculous. I forgot that there was some big number. I was like, oh my God. But that's okay. I mean, hopefully they dropped off because see, they went up. Holy crap. Wow. Oh, he relinquished his salary. I see. I didn't like his salary. That's good. Well, that's obviously showing a little bit more confidence. I thought his salary was too high, so that's fine. Although I don't know how much he's getting in this 10-year stock grant and 12 tranches. He's like doing an Elon Musk thing then. Okay, well, good and bad about that. But of course, obviously the markets like it, so you should like it too as an investor. Do we even have it though? I don't think we ever got any Taser back. We had it from our old portfolios, but I don't think it ever came down in price enough for us to buy it again, which is sad because I really love them. But oh well. Actually, Taser is our stock of the century. No, decade. Sorry, stock of the decade. So our target on Taser was $50. AAXN, and we got out of them because they got so high last year. This is when we got out, like around 30. We said that was a little bit ahead of schedule, and we were hoping. We missed 20. Because you know why? This is when we were shutting our portfolio down. So we didn't get back in. We were hoping it would come back again to like the 20s. It came back here. I wish I pulled the trigger. I didn't, and now it's gone. So now we're not going to get it back, I think. That's a shame. But yeah, this is our stock of the decade. We bought these guys when they were $5, and we said there was going to be a 10-bagger. That was my prediction from basically 2010. And our stock of the century was iRobot, and we sold them too because they went crazy high. So we don't really have a stock of this. Well, we have. I mean, those are our favorite stocks for the decade and century. Any thoughts what you'll do with the March 29 OIH puts in the butterfly portfolio? Aha. Butterfly portfolio. March 29 puts. Oh, wow, they came down a lot, huh? So we're going to roll them. That's what we're going to do. So we're going to, okay, this is a good real world example that we have to look at. OIH, not performing well at the moment. When they were up here, we sold the $29 puts. And what we're going to do, I don't know if this position has been updated. I thought we might have made a change to this, but I don't think it's been updated. What we're going to do here, because we already sold January 23 puts, and we have the January 20 calls. We have not sold any other calls. We have the January 20 calls. So what we want to do is, we haven't sold any calls unless I already made a call like that. I don't remember. OIH. So the March 29 puts are now 465. There you go, 465. And we're going to look ahead and say, where are we going to roll these? Well, we're going to roll them to something, and it's not going to be realistic to go to April because it's too short, but let's say May. And we're going to roll them to the May, let's say 26 puts. No, let's say 27 puts. So we're rolling to the May 27 puts that are just about $3. Okay, and again, at the moment, who knows where they're going to be in 2 weeks. Now, these guys were 465, right? So 465. So we take those puts and we roll them to, what did I say, the 27s. So the 27s for like $3. That means there's 165 short. Then we sell, we're at 24, we sell maybe the 25. Now let's say we sell the 24 calls for 150, 160. So what we've done now, we split the cost of the short puts to the 27 puts and the 25 and the 24 calls. So now what's going to happen? Well, if it stays at 24, everything expired. This expires worthless, and then we're going to roll these again. If it goes above 24, these will expire closer to worthless, and then we'll have to roll these. You see, so you just keep finding a pair to roll to, and eventually, hopefully, you thread the needle. Because let's say it goes to 25, so right now we would have still sold them for 465. If it goes to 25, we owe the caller $1, and we owe the short put $2. So then we would have to pay. We get $3. But what have we done? We've whittled off $1.50 from that cost. So that's what you do. Each time you have to look at it and say, well, how many of these do we want to sell? What's the proportion? And where do we go next? Unfortunately, we don't have there's not a good premium right now in OIH, but it's only 60 days, and we have 688 days to roll. So it's only 1/10. So if we make $1, see, this is the thing that it's hard to get a hold of in the butterfly portfolio. You have to have a sense of proportion. If we make $1 every 60 days, that's going to be $6 that's going to be, that'll be $6 by the time we're done. And if we make $6 against a spread that was net 645 minus 3, so about $3, then we've made 200%. Just making $1 every 60 days. I know it's tedious to try to do it that way, but when it adds up, and when we have 10, 15 positions that are doing that and making that kind of money, it turns into a lot. We haven't added. I have to add butterfly. Somebody was supposed to remind me of that. We have to add some new butterfly plays. The market's just been so crazy, obviously, because we have a loss on here of 2%. We need to. I have been waiting for it to calm down a bit, but it's not calming down. I can still find a couple of good channels though. So I think I still want to add 1 or 2 more butterfly plays. Sorry, Phil was hoping for more of a lesson on how to roll. Very bullish on them. On who? I don't remember who you. I don't remember what it was anymore. ENB. Yeah, I'm sorry. I haven't had time to look at the stock. So if it was one of our stocks, I could get into it, but I don't even know what they're doing or where they're supposed to be. You know, stocks aren't random to me. I have to understand where the company is, and I haven't looked at Enbridge in years and years. You know, so I couldn't tell you. IMAX CEO was on CNBC for 15 minutes ago defending his numbers. Well, I guess it worked. Oh no, IMAX. I'm thinking of the other guy. I'm thinking of Taser. IMAX. Yeah, I don't get it. Is that getting a reaction? Because it's the craziest thing. Where's my charts grid? IMAX. So what are we doing here? 2140. I mean, that's just silly. So it's not working. It's not really getting up any. I can see what, I understand where the guy would be coming from, because I'd be saying, I'm like, what are you talking about? You people are insane. What can we possibly do for you? These guys are like Boeing. They've got a 3-year backlog of orders. I mean, his problem is a mistake he made last quarter, which is the same mistake he made now, is that they're talking about China because they have a competitor in China, and a competitor in China as in the government favors their competitor in China. So it's looking bad for them for that expansion. But it's one country. It's their biggest country, but it's mostly because they've been concentrating there because there was such a demand. There was such a demand that they got screwed because somebody else came along, made deals with the government, and now they're being favored in China. But because the Chinese market was so gangbusters, they concentrated their efforts on China. And yes, they've already installed plenty of theaters, so they're not going to be out of China. But it was going to be their big expanding market for the future, and now it's looking like it's going to be, at least in the very least, very competitive for them. So they have to go to other countries. Turns out, though, oddly enough, there are 199 other countries they could sell theaters to. Doesn't have to be China. It was easy to go to China and sell theaters in China. There was a huge demand. Now there's another Chinese competitor on the market that obviously the Chinese would prefer. Some people want the Chinese company for the stuff. But by the way, that it's not IMAX. And the problem that the new Chinese company is going to have is that it's for the Chinese film industry, they'll use these Chinese cameras and whatever, and they'll have to convert to IMAX and such, right? But you're not going to get Warner, you're not going to get Time Warner and all these other movie companies. They're not going to sell it in MGM or whatever. They're not going to suddenly start making the Avengers in Chinese vision, whatever it's called, because it's not worldwide distributed. IMAX is the global standard. They're going to make movies with IMAX cameras. This is what people don't get. The investors don't get it, apparently. IMAX has a huge, the same monopoly I bitch about. IMAX has a huge monopoly on the global market. There are decades of filmmakers trained in IMAX cameras. You don't just flip cameras. You don't just flip equipment. There's a certain way you shoot IMAX movies. There's a different kind of equipment they use. There's all kinds of things that they're embedded in the Hollywood industry now. And IMAX is everywhere in America. And yes, China's a huge market, but we're bigger. And for the Chinese company to go global and penetrate globally, unless they have a massive price advantage in some way or another, and they don't, it's they're benefiting from favoritism in China. Doesn't hurt IMAX though. IMAX, so let's say their backlog goes. I mean, let's say of their expansion of 170 installations, let's say they did 50 in China last year. The big chunk, 1/3. But because they had orders like crazy in China, because everybody in China wants an IMAX theater, and because all the local governments have tons of money to spend on theaters, and they were saying, of course, we need an IMAX in every movie house. So fine, let's say that's over. So now they got to go back to beating the pavement, selling IMAX theaters to people in Brazil and people in Portugal and people in Spain and so on and so forth. It doesn't kill the company. It can really undo panic. I don't understand people. Apparently, nobody at CNBC understands it either because they're selling. But IMAX goes through these dips all the time. They go up and down with the movies. They go up and down with whatever they're selling at the moment. That's why I like playing with them, though, frankly. I mean, it makes them a more fun company to play. You get in there, you pick them up when they're cheap, you sell them when they're expensive. You know, look at this. This was only last year. $43. Now they're $21. It's the same company. And if you look at the earnings, where's IMAX? We have IMAX. Financials. Okay, last year they made 64. Well, not last year. Sorry. In 2015, they made $64 million. Last year they made $40 million. And that's because they did a lot of installations and they lay out a lot of money when they do these things. Quarterly, they're not showing. So they're in a very big expansion phase right now. So they're not showing any income right now. Let's see what the projections are. You know, so people don't want to ride this out. They're still going to make $1 a share. So they are, well, let's say it's an average estimate, it's $1 a share. Low estimates, 80 a share. I'm sorry, that's 2019. This year they're going to make 80 or 60 cents a share. So, you know, if you don't believe they're going to improve, if you don't believe that they're investing for good reasons, then sure, why would you buy them? But this should be the last quarter that they are in the black, and they're moving into profitability here. And the year is going to end up with a small profit. I mean, this again, when I, you know, as a value investor, I like companies that are in an investing phase, like GE. GE is investing money. They are spending money right now. They're not making money. Some companies do that. You know, not every company just makes money. Some of them invest in the future and put their money into something, into projects, and that will make money down the road. Like FTR is another one. Frontier, which is, you know, we talked about, got a huge hit. People don't want to put up with that. I do. I'm a long-term investor. I like to buy the stock when nobody else wants it. Warren Buffett also has that habit. When a stock goes, when Warren Buffett buys a company, he buys a little, he scales in just like we tell you to. He buys a little bit, then he waits years, and then if it has a downturn and he still likes them, which he almost always does, he buys more. That's how he goes. Eventually, he builds himself up to a pretty substantial stake over decades. Because he's patient and he goes with the management team and he understands how the companies work. You know, and believe me, it's like, again, go to our site right here. Hang on, close this thing. Okay. So go to our site. And if I can ever get, oh, home, where's home? Home, there we go. Much faster. Go to this portfolio tab. See this older articles? Go back. And by the way, if you put like you can change this number. This is the pages. So let's say we go back to 13 pages back. I don't know if there are 13 pages, but yeah. Oh, clearly, wow. Okay, go back. Well, all right, that's fine. So these are our portfolio reviews. Here's September's suggestions for, okay, let's take a look. September 2011. What did we like in September of 2011? We liked Broadcom, huge. Genworth, probably the same price to Genworth. What are they at? GNW. Ooh, they're down. Okay, so Genworth went down over time. We liked HCBK. I'm pretty sure they're good. HCBK. Oh, what happened? They got bought out. MRO. There's an interesting selection here. MRO is now at 1476. They were 25. Man, that's not good. $20 puts, 2024 spread. SanDisk. SanDisk still around? They get bored, right? SNDK. I think they got. Yeah, they got taken out. What a list. A lot of these guys got bought out. Staples obviously took off. Super Value, still about the same price. How's some Super Value doing these days? But same price is fine the way we play them because we don't care. As long as they're not losing money. 14. Safeway, SWY, I think they're gone. SWY. No, they're gone. Safeway's gone. They got bought out. Bought out's good. That means we somehow collected money at some point. And US Steel, which God knows what they're at now, but they've been all over. They've been much lower and much higher, I'm sure, since then. They're now at $44. So, and the point being that we just picked these are value plays. This is why I like them. This is what we thought that was going to happen. And you can go back and look historically at years of picks to see what happened. You don't have to sit there and worry about just the one trade every month that I'm talking about or whatever. You can go back right now and you can look at years and years of research and picks that we've made for people, and you can see how everyone turned out. And the thing you'll notice is that most of them turn out fine because we're value playing. We're picking value stocks. So let's get it to... So here's where we started the, that's a top trade review. That's different. Trade review. Trying to find around where we started reviewing the long-term portfolio when it was new. Cashing out a long-term portfolio. So in 6 months, we already did a cash out in long-term portfolio because we have 20% in 6 months, which at the time, to defend myself, at the time, 20% in 6 months was a lot of money back then. That was considered really good. Here's the trade history in the long-term portfolio. Okay, well, so our initial picks in the long-term portfolio, Apple went up 45%, ABX went up 7%, Broadcom up 41%, BTU up 5%, Cheesecake up 1,200%. Wow, that's pretty impressive. Caterpillar went up 200%. Cleveland Cliffs still playing to this day. That's funny. They're down 4%. DBA, I love these guys as an inflation hedge, 66% that time. Deere was up 135. eBay up a little bit, and Eagle, oh yeah, that was a shipper, 18%. And oh no wonder we cashed these out. Holy cow! And Freeport. You see, it's the same stocks we always play, though. GLL, HK was up. Hovnanian, of course, we always play them. Intel, iRobot, that was back when we still had it. Lionsgate, Lululemon, that was a good pick. They went way up since. Microsoft, we love them. NLY, we always love them. Transocean, at the time, we still liked them. We don't like them anymore. RRD. Another one they unfortunately see they split up and went crazy. And Sears, wow, were we shorting them? No, were we long on Sears? That's funny. We were long on Sears at the time. Made 75%, so it worked out. I turned really sour on Sears after that. Anyway, so you get the idea. So you can go back and you can look at 10 years worth of trades. And you can look at where we went into the trades and why we stayed in them and what we did over the time. Instead of like waiting for one thing to happen now, go study. Because first of all, it'll help you understand that these trades go up and down and we don't just dump them whenever they go badly. We adjust them, we do whatever, but we also don't adjust them the second they change. We wait until we have better information. We wait until we see the next earnings report. Then we say, oh, you know what? Maybe we should get rid of these guys. All right? Or we say, oh, it went so cheap, we're going to buy more. You know, we make a decision when something really eventful happens, not just for no reason. And it's you guys freak out about like a trade going up and down a little bit, or each little trade. It's not worth it. I got 10 years of evidence to prove it's not worth it. So I'm not just telling you that. I just want to say there's evidence backing me up. Thousands and thousands of trades where we do exactly what I'm saying we're doing. We leave it alone. We set up a trade. A month later, we look at it. A month after that, we'll look at it again. And a month after that, we'll look at it again, because it's a freaking 2-year trade with 24 months to go. I don't care what it does in any 6-month period, unless something fundamentally changes in the company. IMAX, we always invest in IMAX. We invest in them whenever they get low. Look at what they do. So let's say since we started here, this is when we were gung-ho bullish on IMAX when we started. Then they went up here, and then we decided the range was somewhere between 20 and 30. So when they get down by 20, we buy them. When they go up to, past 30, we tend to sell them because they always come back. Now, one day they won't come back, like iRobot, which we absolutely loved. Couldn't love a stock more than iRobot. But it went crazy and we got out of it. And we're probably never going to go back in, because I can't stomach going in at this kind of price, even though I love the company. And also they sold off their military division, which really pissed me off. But apparently it wasn't a bad idea. But I was bang. Again, it was in here, 2010. I said this was our stock of the century. And I said it would be a 10-bagger, and it practically became a 10-bagger over here. And that was it. We got out. We were done with it. So it was nowhere near the end of the century. We're nowhere near the end of the century. So it was time to get out. And then Taser AAXN is our stock of the decade. And it's same thing. Here's where we came in, $5. We said it would be a 10-bagger, go to $50. Okay, it went up here to 30-something bucks. We got out. We got out here, we got back in here, then it went back to here and we got out again. This is a double. Because we're not playing a chart, and we don't have ridiculous anxious expectations. We know what something is worth. And if you know what a stock is worth, you sell it when it's paying more than it's worth, and you buy it when it's being less than it's worth. So then we go back to like GE, and I'm telling, my attitude is GE is worth $15. I'm willing to put my foot down at $15. It's been higher, it's been lower, but I think 15 is a good price. How does that say 1-year chart, but it shows 2? Why does that say 1 year, yet the chart clearly shows 2009? It's really weird, isn't it? Anyway, GE was once, if we take the chart over here, GE was once way the hell up here at 40. And now it's at 14. Now, it's not the same company anymore. You have to take that into account, though. This company is not going to 30 because it's not the same GE that was at 30. They sold off a bunch of divisions. They cut their company in half. It deserves to be at 15. But 15 is a great price, and we're willing to hold it at 15 because eventually they're going to start making money again. But even in a downturn, the way they've cut their companies down, now it's still worth 15 for sure. I don't care that somebody else is willing to sell it for 14. That's their problem. And I don't care if it takes 2 years to go right, because our position on GE is, I don't even know right now, but let me see. Long-term portfolio down 3% today. GE. Hopefully the other one's making money. Oh no, do we not have GE in this portfolio? Oh yeah, there it is. So we have the $13 calls. We paid $3.80 for them. They're $3.38 now. Yes, they're down. We sold the $18 puts, but we sold them for $2.40. That means our net is $15.60. And they're down 94%. In fact, that today is probably all the loss we have today in the LTP is probably coming from GE and Frontier. So they're down for now, but that's not the trade. We have 2 years on this trade. We're going to ride it out and wait for them to recover. If they don't recover in 6 months, I'm going to start getting worried. But I think they'll be back over 15 in 6 months. As long as they're over 15, these puts are going to pretty much expire worthless. So I'm going to collect, instead of losing $4,500, I'm going to make $4,800. That's going to turn around by the entire now $9,350. These calls, 13s, will cap them at some point when they go up, but I'm not in a hurry to cap them. I don't know where GE is going to end up, but hopefully we can sell the $20 calls for a couple of bucks, and then we'll be in this thing for net 180. Not even net 180, net 180 minus the credit for the short puts. But let's see, GE. But you know what? If I want to do that, I have to be patient. I can't do it tomorrow. I can't do it just because it popped for 5 minutes the other day. Although we did make money on this really short-term plays. But here, the 20s are now $1. So if the 20s go up to $2, I'm going to be very inclined to sell it. Because I certainly don't think they're going to be more than 20. That would be incredible if they go up past 20. And if they do, then I'll sell it. Because first of all, it's plenty of money. We're going to make 7 times whatever the hell, 50. So it's $35,000. But that's 2 years from now. Today they went down. Tomorrow they might go back to 15. 2 weeks from now they might be at 12. If they're 12, I might be inclined to do something like add more somethings. But right now, 14 is not enough of a. Even though it's even though it's like $10,000 in the portfolio, whatever the hell we're down. Not 10, 6. So we're down like almost $7,000. It's a $500,000 portfolio. This allocation block is $50,000, and it's down 7,000 out of 50,000. It's not that it's down 7,000 or 100% here or whatever. It's not that. It's down 7,000 in my $50,000 allocation block. So do I want to take a hit in my $50,000 allocation block of 20%? Which translates out to 2% of the entire portfolio, not even, or do I want to use more of my allocation block, the remaining $43,000 of my allocation block, to improve the position? That's all that I have to decide with GE. So at the moment, when I say I'm going to leave it alone, I got $43,000 of buying power to throw at this thing, or I shut it down, take a small loss, and move on to something else that's better performing. Look at freaking Chipotle's up $45,000. That one we should do something about. Frankly, we have no short calls. We're just letting that one run. See, that I'm more likely to do something about that because that's where I have money. I want to lock in a gain. Wow. Yeah, here's where we were going to sell. We're going to sell about 340. I don't like that. I don't like making $45,000 in one position. Why? Because it's 100% of my allocation block. It's a $50,000 allocation block. We made $50,000. That's time to get out. For one thing, that's 10% of the entire portfolio in profit on one position. You shouldn't be riding that much. Now we have too much money in that position. So we're probably going to cash that and do something else, or in the very least sell calls against it. Because it just flew up on us. But what? And by the way, why did we make so much money? Because when it fell, let's see. I don't remember when we went into CMG. But we did exactly what I'm telling you guys now. I'm very consistent. That's what I'm saying. Go back 10 years and you'll see what we do. We started the position on 1-2. Okay, so let's now look at the chart again. So January 2nd, I think they were here. I think this is when we started. We bought them when they were cheap. We didn't buy them when they were expensive. So we bought them at $295. They went to $345, and we said, yay. Then they fell back, and we said, oh, well, it's back to where we were. No big deal. Then they gapped down. We looked at why they gapped down. We said it was stupid. and we bought more. That's when we added the calls, or we rolled the calls down, or whatever we did. I think we bought back. I think we had a spread. We bought back the short calls, and we rolled the long calls down to a much lower strike. Then it took off again. Now we made a fortune. We had a very, very small loss, I think, on the first set because we had sold the call, so it evened out. And now this set we went naked and we took a risk, and it completely paid off. But why is that? It's because we know what it's because we know what Chipotle's worth. It's worth about $300, $320. That's where we think it should be. So when it goes higher, we're skeptical, and when it goes lower, we think we know that it's ridiculous. So we put our foot down. We use more of our allocation block and buy more because we know what it's worth. You have to know what your stocks are worth. You cannot have a squiggly line on a chart tell you what your stock is worth. Your opinion can't change every day depending on where this thing is. See where we are right now? We're smacking up on that 200-day moving average. So of course we're hitting resistance, right, at the 200-day moving average. And that's going to be tricky to get through. But once again, if we consolidate above the 50, it's going to pull this line higher. The 200 is going to keep going lower unless we get back over it. And even if we do get back over it, the momentum is still going to carry it down. So what's going to happen here is every day that we're above 310, and especially above 320, we're going to pull this guy a little bit closer to 340. Now it's 50 days, right? So in 50 days, if we're at 320 and we're $14 above or $16 above here, that means that in 50 days, it's only going to move 50 cents a day. Creep, 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 creep. So to get to 320 is going to take 50 days, or I'm sorry, it's going to take 20 days. So at the end of next month, we'd be the 50 day. If this stays here at the end of the month, the blue line will be at 325. See, I can tell you that. That's what's going to happen. And this line will drop 1/4 as much because it's a 200-day moving average, not the 50-day moving average. This line will drop 1/4 as much if it stays here in between the two. So this will go up 50 cents and this will go down 12 cents a day. So in 30 days, this will go down $3.60. It'll be down to like $3.35. So what's going to happen at the end of next month, if Chipotle stays, now again, obviously it's not going to stay exactly 325, but if it stays generally in this range, if it does one of those little triangle squeezy things where it looks like it's going to consolidate, and if it stays between these two things and it stays around this average, what's going to happen is the 50 will move up to 325. This guy will come down to 335. Then how long will it take? 2 weeks. So 6 weeks from today, the 200-day moving average will be crossed by the 50-day moving average. And then Chipotle will either go very far up or very far down, but most likely up, because this would indicate it's consolidating for a bullish move up. And the cross will be a beneficial cross in 45 days from today. That's how you make a prediction in the market. Now, that will be confirmed by watching it stay in this range. If it falls out of this range, that's going to be a more negative viewpoint. If it goes up out of the range, then it's going to be, it might happen a little bit sooner, and we would adjust accordingly. And that's where it is. But since I generally think the market's still going to correct, and the Dow's down 30 at the moment, if I generally think the market's going to correct, I don't want to leave that exposed with a $45,000 gain. So we're going to move to a more conservative position that probably uses less of our cash. That's all. And what it will be, I don't know. But I'm just saying, so that's how you play it. And when, by the way, when I say I update the portfolio once a month, because that's how you update a portfolio. I have to look at every position, think about what it's going to do for the next 30 days, and then make a decision. I don't do that every week. That would be insane. It takes me days to do this stuff because I have to do exactly what I just said with every position. And then plus go back and read the fundamentals, see if any news has changed, find out what's going on, and try to figure out why this, why did it do whatever it did over the last 30 days. Have to know that too. Otherwise, what's the point? All right, Celgene had a death crossing 217. Now it's down a bunch on some more bad news. Have some short 2020. Celgene is the ones they paid too much for somebody, didn't they? Celgene, didn't they buy somebody for some stupid amount of money? Or is somebody buying Celgene for a stupid amount of money? No, that wouldn't make sense. I think it was Celgene, because I can tell you why. Celgene had no pipeline, and I believe they did a Hail Mary to buy somebody for way too much money. So they're down for perfectly good reasons. Oh, God. Ugh. That's ugly. Wow. Oh, they have the nerve to call themselves a biotech? No, they're not a good company. They some bad FDA news. Yeah, well, the bad FDA news, I don't know what it was, but they have no pipeline. Their pipeline is shrinking and shrinking and shrinking. So if the couple of things that they have left, they got some bad news on, I can see where the bottom would come out. You have some short 105 puts in March. Should you dump them? I don't know. Again, ask me in chat, because I have to really look at Celgene carefully to answer that question and figure out if it's worth sticking with at this price. I mean, I wouldn't say it's bottoming, but we can take a quick look and see what they're trading for and see what it says. Again, my issue with Celgene, the reason we soured on them last year was because they had no pipeline, nothing really going for them, and they were making a desperation acquisition, which I cannot remember what it was, but I'm pretty sure that was it. Celgene run of bad luck continues. Oh, Receptos was a huge mistake. Yes, it was a huge mistake. That's what I said when they did it. They got to catch up and figure out what they're doing. Oh, application setback on the MS drug. That's not good. Wow. What does that mean? They refuse their application. Oh, that's not good. Crazy. Okay, anyway. So their problem is they only have a few drugs. They don't have much of a pipeline. The guys they bought was like a Hail Mary, and that was a bad move. There's earnings. It's not only they don't have money. So they got revenues. It's basically steady. It's going up, in fact. They're selling at a good profit. But some of the stuff that they're selling is going to start getting some serious generic competition, and they don't have a lot in the back pipeline. So long term, they're scary. But they made $3 billion, and you can buy the whole company for $66 billion. So basically, 20 times earnings is a little. If they're not growing quickly and they don't have if they got issues, you don't want to really pay more than 20 times earnings. So probably, $60 billion, so 10% below here would be probably a place where I would start getting interested in them. Again, depending on what I would read. I mean, assuming that they aren't worse than I think. But given that they can basically maintain where they are now, that they're not going to do any more stupid acquisitions, which frankly I wouldn't put past them. So that's the problem. It's like I wouldn't trust them not to do any more stupid acquisitions. Where was that? Celgene. Juno. Oh yeah, Juno too. Oh, yes, disaster. Yeah, you see, that's the point. They made more than one bad acquisition. So that's a terrible use of capital. When you see somebody doing that, and you see them overpaying for somebody, they're out of ideas. That's the same problem I have with stock buybacks. If you can't think of anything better to do with $5 billion and buy your own freaking stock, then you probably shouldn't be in the business. You can't build a new plant. Your business isn't worth investing in a new plant. Your business isn't worth in starting a division. Your business isn't worth putting more money into R&D. Instead, you're going to buy your own stock and leave everything else as it is. That is stupid. Now, a company like Apple, who takes 25% of their money and buys their own stock, that's not so bad. It's the companies when I say they buy their own stock, like they take pretty much all of their cash and buy their own stock. or they borrow money to buy their own stock. That's the worst. That's ridiculous. Apple is spending a fortune on R&D. Apple's basically saying we can't spend much more on R&D. We can't spend much more on development. We can't spend more on manufacturing. We're already doing everything. So now we still have this $250 billion sitting around. So I guess we better buy back $25 billion of our own stock. That's not terrible. That's an okay way to decide to buy your own stock. It's the companies that spend like a huge portion of their cash reserves to buy their own stock. Those are the guys that have no other ideas. You know, Buffett's not buying his own stock. Buffett will buy his own stock if it gets cheap, but he won't buy his own stock, and he's just sitting on a ton of cash. He also won't buy anybody else's stock because he thinks everybody's too expensive, which should tell you something, but it doesn't. That's why this market's so insane. It doesn't matter. Even if Warren Buffett flat out says, which he just did on Saturday in his report, he flat out said, everything's too expensive. I'm not buying anything. There are no bargains to be had. Even though Buffett says that, the market still doesn't go down. That's crazy. That just means value is thrown out the window completely. Oh, anyway, I'm sorry. I was going to look for your thing. So you have the 105 puts in 2020. Yeah, I mean, it depends what you sold them for. I mean, I think 80 is not such a bad price. So if you sold them for 10 and you're in for 95, it's not unreachable. And meanwhile, you're going to take a big loss now. So I mean, I don't think I'd be so inclined as to not take a chance. But again, if it's tying up margin that you could put to better use, then no. If it's margin you don't care about, I would probably leave it and see where they settle in. Farm Boy says Celgene screwed the pooch yesterday, but I would sell some puts in June, July in the 70s. In the 70s, yeah, it's not going to help him. That doesn't help Ori. Otherwise, my little gem has data coming out in a few weeks. Fell, yeah, right. No, I don't think it's a little gem. I'm sorry. No, I think this is a company that ran out of ideas. That their big idea then was to here's where they ran out of ideas, and here's where their bright idea. Now they're churning, still making tons of cash, but then they say, "Oh, I know what would be good if we buy some other companies that have some ideas." Turns out. You're a one-trick pony. They're not a one-trick pony, but you know what I mean. You're a one-trick pony. You buy another one-trick pony, and now both your tricks are out. But now neither one of your tricks are working. That's not good. So I don't. That's why when I invest in pharma, I'm almost always buying Pfizer or Merck when they're down because they've got massive pipelines, unbelievable amounts of cash, and whenever they run out of ideas, they know how to buy people. Their management team has many decades of practice buying companies that have a proper pipeline and are cheap and fit in their culture. It's not a random buy. When Pfizer buys somebody, they buy somebody because we have see, here's the thing you have to consider when you're buying somebody. Do we have the sales reps who have knowledge in that area, who already have relationships with customers who are going to be likely to want to use these drugs? Are we talking to the right doctors? Okay, there's different kinds of doctors. It's not generic. If you have sales reps selling certain kinds of drugs that you want to put another drug in the pipeline, you should put a drug in the pipeline that they can go back to the exact same doctors with the same pipeline. You don't want to randomly do it. Now in Pfizer's case, they probably have different sales reps selling in many pipelines. So, I mean, again, huge advantage for them because they can pick up all kinds of companies. Celgene is selling a multiple sclerosis drug. They pick up a guy who does a diabetes drug. It's not the same doctors. It's not the same salespeople can't go to the same doctors. So what are they going to do? They're going to split half their time on two different drugs. They're going to have to learn a new drug they don't know anything about and start talking to people who know. And now, because see, here's the thing, they might be incredible experts at multiple sclerosis and be able to talk about the disease and all the effects and the cure and so on and so forth till the cows come home. But if they go talk, now they have to learn a diabetes drug and they don't know anything about it. And they're going to talk to a doctor. They're going to make fools of themselves by comparison because they aren't doctors. They're salesmen. But they probably have some background in medicine. But generally, these sales guys are going to go out there and they just don't have the experience to have these discussions. And they're going up against other salespeople who do have the experience. So not only are they taking their time away from the stuff that they usually sell, but they're doing it in a way that's wasting their time. And this is what Celgene doesn't take into consideration. Not just Celgene, though. This is what all these companies do. They don't really think it through. And that's why I like Pfizer and Merck, because Pfizer and Merck obviously have the experience. They've got the numbers. They have the ability. They're in every facet by now. They may have made those mistakes along the way, but they made them 20 years ago. Now they've got the salespeople in all the different places. They know how to fill their pipeline. They know exactly, in fact, they know exactly what their pipeline needs at any given moment. So when Pfizer picks up a company, they pick up a company that fits exactly with what they need. They don't randomly just grab a company because they have a hot something. And that's why people always say, well, why is Pfizer and Merck, why do they let all this stuff pass them by? It's not passing them by as far as they're concerned. They can buy anybody, anytime, for any amount. But they don't. They pick up what fits, just like Buffett does, and just like I do, frankly. We pick up what fits in our portfolio and is going to make it stronger, not just because it's a stock. It's got to diversify. It's got to bring in the money. It's got to give us a good reason that we're getting into it at this time. It's got to be something that fits with our investing philosophy and our time frame. Otherwise, we don't buy it. You don't have to buy every stock that sounds good. You don't have to buy every company that sounds good. And this is how these guys kill themselves. This is how perfectly good companies take all the money they made for the last 10 years and blow it on something. They blow it on one acquisition, and then if that acquisition fails, they basically blew the entire company. That's crazy. All right, guys, going to have to wind this up. Let's see how the market's doing. I didn't have much chance to look at the market today, did we? Good. All yapping about other stuff. So, charts. Yeah, so, you know, look, it's weak. We're in the same weakening phase. In fact, well, damn it. Okay, that would have been a good short. That same 69.50. This is where 69.50 is the first mark that I shorted on Monday at that Traders Challenge. And again, what do we know from the big chart? This is really important, though. What do we know from the big chart? Why do we have a big chart? What's the point? The point of the big chart is so you can quickly say who is the most overextended. And the Nasdaq is. They're up 30%. He's up 22.5%. He's up 25%. He's up 0, and he's up 7.5%. So the Nasdaq is the most overextended. So if everybody's coming down, the Nasdaq has the furthest to fall. That's why shorting the Nasdaq is the most fun. So I'm sorry we were yapping when it happened, but 69.50 was a great place to short them. All right. But again, the things I shouldn't have to tell you that. It's the same line we've been using all week, right? It's not, I don't have to make the call. This is our line. And this morning we shorted the Dow at 2,500. And it didn't work the first time, and then it worked the second time. And the Nasdaq here. Here's the and we know that we know that we were looking for 25.50 if it failed, and 27.50. 27.50 failed. That made it a good short also. And now we know where it's going to bounce at 38, right? Or basically around this line. It's going to bounce at 35, I think we decided, right? And on the Russell 2, we've been shorting 15.50 forever, so that was an easy one. And now we just wait and see what happens on the next line. But that's it. It's not complicated to do these things. Oh, look at oil. Oil really came down. That's almost worth a toss there on oil. Gasoline, I don't like gasoline up here. I still wouldn't go long. It's just I don't like 192. You have to realize that it's sticker shock at the pump. So it's going to now further impact demand next week because the price of this month's gasoline is ridiculous. It's going to have to come down to a price. These prices don't exist in a vacuum. This is the wholesale price of gasoline now is $1.90. It was $1.80. It's up 10 cents. Are people at the pump ready to pay 10 cents more a gallon? No, because you know what? It pushes it over $3. Generally, we're under $3 now. If you push it over $3, people start waiting to buy gas, and that really hurts next week's inventory. That's all it takes. A little sticker shock at the pump, and people put off filling up their tanks. If everybody puts off filling up their tanks for a day, that's 10, 12 million barrels of gasoline that don't get used that week. Now, it gets made up, of course, because eventually they're going to buy the gas anyway. But it's in the time that it happens, you have a real big problem. So I wouldn't look for gasoline to go up. I wouldn't say it's going to, just because it went down a lot, doesn't mean it's going to go up, because this amount was stupid. And we knew that, by the way, on the rollover, because we were talking about how 20 cents was crazy for a rollover. It went from 82 to 20 to 2. It went up 18 cents on a rollover. That is a lot. And of course, so what's happened since then? It's come down 7 cents already. It's closed half that gap. It's going to probably close the rest of the gap. I expect to see 185. So you could short gasoline here, but it's so dangerous, I wouldn't do it. I mean, it's tempting, but I wouldn't. The Nikkei is oddly weak on a strong dollar. I mean, so there's bad stuff going on in Japan, of course. They just had bad manufacturing numbers. But this is uncharacteristically weak. And that, by the way, that should make you more nervous. Strong dollar, usually good for the Nikkei, but the Nikkei is actually following the markets down. Oh, and they're selling off worse. The Nikkei's following markets down. That's bad. See, if the Russell fails this line, that's not good. And then once the Russell fails that line, the Dow would fail it next. And if the Dow confirms, then you short whoever is the furthest away from the line, which is going to be the Nasdaq. We're back to, so you'd be back to saying, oh, short the Nasdaq. So if the Russell goes, if the Russell goes below this line and the Dow confirms by failing this line, then the S&P obviously doesn't even hit resistance until it hits that line. So the best one to short is going to be the one that's closest to the pink line, which is the Nasdaq, at 25. So just as it's crossing 25 is the place to go short. He's clearly below now, and the Dow is going to test it. And if the Dow pumps right through, wow, 134 down. Holy crap. And this line is like well, it's actually far away. This line is 270, let's say. So we'll see if it holds up. I don't think it's going to go below it. What we've done is we've now completed a complete reversal of the stupid rally that never should have happened in the first place from Monday. We've now reversed all of the gains from Monday, which was an idiotic rally, and now we're back to where we were. So I think this is about right. I think now we'll see what happens in the next couple of days. But on the whole, all we did is erase that very low volume. And you can see, look at the volume here. Look at Monday's volume, and look at this volume. It's easily double. And this volume is still much higher, probably 50% more than Monday's volume. So we went up on no volume, and now we're coming back on normal selling. That's all. This was stupid. We started at a point that had been determined by a week of selling and buying. So that this you could say is kind of okay, kind of where we should have been, is where we started the day on Monday, right here. But this was nothing. On no volume, we went up and up and up. And then when the real buyers showed up and the real sellers showed up, we started selling off again. This is why I always say Mondays are bullshit. Mondays do not matter. Happens all the time. Whatever happens Monday is reversed. So nothing compelling here. I wouldn't jump on any of these. It's just a watch and wait. We got to see where things settle out. All right, so that's it for this session. Thank you everybody for coming. And it seems, what? After I did that 4-hour thing on the weekend, this doesn't even seem like it was a long time. Usually I'm exhausted. Now I'm in shape to do 4 hours, but I won't. All right, so that's it. Thank you everybody for coming, and we will do it again next week. All right, take care.